Welcome to All About Stocks. Thank you so much for tuning in. I'm Faye D'Souza. Now, the Modi government has completed 1 year this week, and we have a special episode today. We're talking about how this government has done, if it's managed to fulfill its promises or live up to its expectations. And Andrew Holland, who joined us in the studio before the budget, is back again to review the government and to help us with our investment strategy. Now, remember, if you have questions about your stocks, you can write to us. Email ID is at the bottom of your screen, or you can reach me personally on Twitter as well. Let me bring in my colleague Ajay to give us an update on the Lal Street this week. Ajay.
Well, Faye, we have finally managed to eke out about 1% gains this particular week for Indian equities, and this has happened after 3 punishing weeks when we lost almost 1 to 2% average on a weekly basis. The biggest reason for this has been because the FII selling, which was extremely accelerated past couple of weeks, almost 1,500 crore to sometimes even 2,500 crores on a daily basis, that seemed to have gone down pretty much this particular week. We have almost seen about 70 to 80 crore of selling each day, not more than 250 crores in the best case scenario. So that has gone down. And on the other hand, DIs have continuously been buyers of Indian equities, very aggressive buyers. So that has cushioned the fall and has managed to give out about 1% gains on the benchmark. In fact, the mid cap and the small cap end of the market has managed to gain much more than that, 2 to 3% gains coming in. Even the HNI and the retail community is not afraid of the market coming on declines and have been value buyers. That has cushioned to the fall to a large extent. Not only that, this week the earnings from corporate India, the Q4 earnings were much better, or sometimes even have beaten estimates. So that negativity was missing in the market. Global Qs were pretty positive and supportive. In fact, that entire the sell-off we were seeing in global bond yields, that eased, and that supported sentiment to a whole lot.
All right, Ajay, thank you for that update. Right now in the studio, Andrew Holland, CEO of Ambit Investment, joins me. Andrew, thank you so much for coming in. It is an absolute pleasure.
Thank you.
You know, the last time we spoke, this was about 5 months ago. We spoke before the budget, and you were really positive about how this would play out. I want to understand from you, do you still have a fairly high target for the Sensex and the Nifty by the end of this year?
Yeah, I haven't changed actually. I mean, don't get me wrong, it's going to remain volatile for the next few months. And last month was actually very brutal. There was no place to hide. Even the defensive sectors hurt you. So even though the index was down, 3.6%, I think most people were down between 10 to 15%. I mean, that's how brutal it was last month. So expect a bit more volatility. But the underlying market still looks very attractive. So, we had a very quick look at, where the PEs are for the underlying market, stripping out the main 3 sectors of IT, consumer and pharma. And you're still on a PE of 11, 12. So that's where the value is.
All right, I want to take you back to some of the advice you gave us the last time you were here. We talked about, infrastructure. We talked about what you call Supply India. I want to talk about infrastructure first. It hasn't been a great story. It hasn't really played out. Okay, let's put it that way. Are you still bullish on infrastructure? Do you think that the government's push of infrastructure will actually play out over the next 1 year at least?
I think it is. What happens with infrastructure is that, awards of contracts go out there and we kind of see them. It gets, X, Y, Z, wins an order. But, building a road or, building new tracks for a railway doesn't really it's not touch and feel, right? Whereas, consumer, you can see people buying cars or the car numbers come out. So, the orders are being given out, and a lot of companies we're speaking to are saying we're starting to get the first wave of orders. So things are starting to pick up slowly. It's not been, it's not going to be a big increase, but we are starting to see that now with companies, and the more people I speak to are getting more optimistic about the order levels that they're getting.
So what is your view on the infrastructure sector right now? Would you say that investors need to start buying infrastructure stocks at this point, or would you just say if you have an infrastructure stock, you should hold on to it?
So again, I distinguish between the asset owners within infrastructure. I don't want to own power plants at all. What I want is the suppliers to the power plant, because they're going to be the ones who get the order first. And 2 to 3 years down the line, when the power, when the power plant comes online, then that's when that company will earn its earnings stream. But I want the companies which are going to supply the parts now. That's where you're going to get the operational gearing and the earnings pickup. So I don't want to buy an NTPC. I want to buy a say, a Siemens who's going to supply some part of that power plant to NTPC.
Explain to us how you're reading this market. I mean, we don't have to be rocket scientists to guess that it's volatile. I mean, any investor who's looking at the market up one day, down the next, I can't really make head or tail of it. Explain to us as retail investors what do you think is actually going on and how we should sort of read this market.
I think the way to read it is not to get overly bearish, right? And it's easy to get bearish at the moment. So what we did was say, okay, why did I originally become bullish? Okay, was it because of Prime Minister Modi's mandate? The answer was no, because we didn't know in September 2013 when we became bullish, we didn't know the BJP would win that kind of a mandate. Was it because of big reforms? No. Was it because of the land acquisition bill going through? The answer was no. So all of those three things that everyone's disappointed about now was never why we became bullish.
So why did you become bullish?
Became bullish because we expected GDP to gradually increase.
Okay.
I'm using the old figures because I don't quite understand the new figures at the moment, but 4.5 to 5.5 to 6.5.
Okay.
Okay. Operational gearing to start kicking in as the economy grows, which will obviously help earnings, and lower interest rates and valuations. So even if I go back to September 2013, so that was the only thing that you had to look at really, because all the other three had happened. GDP is starting to pick up, operational gearing is starting to improve, and lower interest rates.
Not really lower by much, is it?
50 basis points.
I mean, if I remember correctly, and you said you expected 100 basis points by June, 250 basis points over the next 2 years.
Yes, which I'm sticking
You're
to.
still sticking to.
I'm still,
okay.
I mean...
Are you still expecting another 50 basis point cut before June? Because we're mid-May.
I am.
Are you really?
I'm still optimistic. When I look at WPI, CPI, the industrial production figures, it all tells you he can reduce interest rates by 50 basis points. I mean, outside of India, you know, we're in a currency war, right? Everyone's depreciating the currency. And when our currency was falling, I think, the last few weeks, actually for the year it's down 1.7%. Why are we so worried? You know, if 50 basis points will not move the needle of the currency, it won't move. He can do 50 basis points.
You should tell him.
I'm telling him now, I hope.
All right. So you're expecting better, you know, lower interest rate.
Yes.
Let's talk about earnings, because that's another thing on your list. It wasn't great, let's be honest. And, you know, the market sort of reacted to the fact that we're not seeing those numbers improve right now across the board.
Right.
Were you also disappointed, or have you found a silver lining in the earnings as well?
Again, I'll go back to the valuation part. So September 2013, strip out IT, pharma, consumer, underlying market was on a P of 10-11. Do the same exercise today, underlying market's on a P of around 12.
Okay.
And you've had earnings growth in the underlying market as well. So I think what's going to be difficult for investors is to look at the index. Because in the index you're going to have sectors like IT and consumer, which are going to show you very little growth, right? But the PEs are high. So your earnings growth is going to be skewed by heavyweight sectors, which are not showing any growth.
Right.
Because your underlying market is showing you the growth. And that's why you've got to look outside of the index at the moment. So I'm not disappointed in earnings. I've never expected earnings to grow so quickly. I'm looking for 15% this coming year.
Okay.
And I really feel confident that will happen. Because as the economy starts to pick up gradually, you will get the operational gearing playing in for India.
Welcome back. You're watching All About Stocks in ET now. Thank you for staying with us. Andrew Holland is with us in the studio, and we're figuring out our strategy for our long-term portfolios. Andrew, I want to ask you a very simple question. If I walked into your office today with 100 rupees and said, allocate this in the stock market for me, and I'm a long-term investor, I'm going to be here for at least 5 years, how would you split up that 100 rupees?
That's a very good question. Only in the equity markets, right?
Only in the equity markets.
So I would have a large weighting towards banks. I'd probably put 50% towards banks. Mainly the private banks and a few PSU banks. But I still have to do a little bit more work on PSU banks. I'm not convinced that the bottom is there. But
so if I'm a slightly conservative investor, then I'd go all private banks?
Yes.
Okay.
So I'd put 50% there. And then the balance I'd put across who supplies India theme, and you're going across all different sectors and picking out the best companies. So I would have your balance of maybe 10 to 15 companies split equally with the balance of 50%.
Give me a tracker. I mean, when you say supply India across sectors, it's a huge list, especially if you're looking outside of the index, which a lot of retail investors tend not to do because the index is there, it's a list for you to work with. So if I'm looking outside of the index at the broader market, give me at least a checklist that I can work with saying that, okay, this stock checks this point, this point, this point, this point, so I can buy it. So,
right.
So help me do that.
So for example, you know, the supply India theme will go across your economic and your market cycles. So at the early part of a bull market, it's more cyclicals, so it's industrials.
Right.
So you got your Siemens, your ABBs, your Alstoms, your L&Ts, your BHELs, right, in terms of supplying infrastructure. And then you go to your mid-cycle. So if you believe that India is going to be seeing a lot more travel, tourists coming into India as visa on arrival comes in, then maybe hotels.
Right.
Because again, as rooms fill up, their occupancy rates go up and they have pricing power and their profits go up significantly. Yes. And then towards the end of the cycle, if you want to go towards the end of the cycle, then you'd be looking more towards the consumer stocks. So as a pickup in maybe rural spending would come through, then you can look at some of those types of companies. So you can go across and look at your valuations across each of the kind of early, mid and late cycle sectors, keeping more towards the early to mid cycle sectors first.
So, I mean, going by the earlier conversation, you believe we are early cycle right now?
Yes, of course. Yeah, we're only starting this bull market. Although I heard someone the other day say it's the end of the bull market. So.
Well, that would be a pity, wouldn't it?
It's only the first year of it.
All right, so it's the first year of the bull market. I also want to ask you this. You did say you're bullish on banks, and you've been bullish on banks for a while, and I would assume so if you expect, you know, another 200 basis point cut over the next 2 years. And we talked about supplies to power, companies. What about those companies that do finance for infrastructure and power? Is that something that you'd also find interesting?
We have looked at them, but I think that the banking sector is at valuations which are still compelling enough for me to capture the whole of the economy picking up rather than just one particular sector. So I'd rather play the infrastructure sector by the supply side of actual, real kind of goods rather than service at the moment.
All right, so we also talked about the fact, when the Modi government did come in, let's be honest, there were a lot of hopes pinned on one man. And everybody expected him to change things overnight. I mean, it's been 365 nights. And if we were to look back at what's been achieved so far, from the point of view of the larger picture, let's assume that we had expectations for 5 years, and we're done with 1/5 of that. Would you say that the government is still looking as strong, or for you, you're still optimistic about everything you expected a year ago?
I'm being kind of, my kind of optimism has been blurred by what's happened recently. And what's happened recently is, 2 big reforms bills have not got through. And that I think, we're pinning a lot of hopes on. I mean, the Make in India, if you don't have a land acquisition bill, how can you make in India? So I think that's been a big disappointment. I think the MAT issue was very badly handled, and now it's been swept under the carpet. I mean, that was we just didn't need to go down that route. I don't know why we want to have this, what's so-called tax terrorism. I don't know why we want to do that. So that's what we remember the first year by, is those negatives rather than the positives. And there has been many positives. I think the economy is starting to pick up. I think there is a genuine feel of trying to ease doing business in India. And, a lot of companies are saying it is becoming a little bit better, but it's still slow. So it's not filtered all the way down. And that will take some time.
Do you think as investors also it's possibly necessary for us to temper our expectations of what our stock market can give us? Or, the kind of buoyant optimism we had last year at exactly this time? Or do you think that was fair?
I think that was fair because, I don't think, valuations were so low, if you think about it, on the underlying market. When you could buy sectors under the PE of around 8 or 9. So, I think that re-rating had to happen. And for a lot of companies, and again, I'm going back to operational gearing, you see that share prices have moved up, but actually earnings in some of those companies have more than doubled or trebled. So it's actually a realignment to what's really happening with their earnings going forward. So I'm less worried about that part of it. What I tend to worry about is that for the time being, for the next few months, and I say in the next quarter, that there's no catalyst for the Indian market to move higher. So then we're hostage to what happens globally. And globally in June, do the Fed increase rates or not? Do the rains happen or the monsoon happen or not? Yeah. So these are the kind of things out of our hands. But there's nothing to going to move the market a lot higher. So I think we're in a trading range. So it's a great opportunity to pick your stocks and, now when the volatility is there, and hold them for the longer term.
Welcome back to watching All About Stocks in ET Now. Thank you for staying with us. Andrew Holland is with us as well. We're talking about investing for the long term. I remember you said you were very bearish on the oil and gas sector. Are you still bearish on the oil and gas sector?
Yes, I am. Okay. I still remain that way. I still think oil prices are coming down. So I just can't see the growth there. The only stock which we've become a little bit more optimistic about is Reliance.
Why is that? Not
because of the oil part of it, but I think we're coming to the point now where it's CapEx spending is starting to slow down. They spend a lot on retail, they spend a lot on telecoms, and I think we're coming towards the end of that now, probably by September. And once we start seeing some transparency in what they've been doing on the retail side and the telecom side, I think we're probably going to like what we're seeing. We've seen quite a number of changes in the retail sector anyway recently in the markets, yes. And that's been well received. So I think this could be a positive for Reliance going forward. So it'd be a catalyst for the share price to move higher because the CapEx cycle will be out of the way, and we can start seeing some growth in those businesses.
So do you have a buy on Reliance at this point then, at these values?
So we have been looking at picking the stock up, yes.
Okay.
Yeah.
So tell me, outside of Reliance, when you say you're bearish on the oil and gas sector, is that everything upstream, downstream, oil marketing companies, all of them, avoid them all?
We want to find out who's going to supply these companies as they start because they have to do CapEx.
Sure.
There's a lot of companies will want to put down some more gas pipes and so forth. So who supplies the gas pipes? That's the company I'm after. Not Gale, who owns the gas pipe.
Okay, I know that you said consumer stocks come into focus towards the end of the cycle, which is, if we're looking at a 5-year cycle from what you told me, then that's a couple of years away at least. But I want you to help us understand maybe a stock like ITC at this point. Because if the market comes down the way it has over the last couple of weeks, it's a good time to pick up a couple of blue chip stocks. Would you recommend a couple, consumer stocks at this point, or would you say look for the big banking guys because that's where 50% of that 100 rupees is going to go?
Yeah, I don't think I mentioned any of the consumer stocks.
No, you didn't.
In that. The way I think about it, it's maybe slightly different. But if you go back to the last cycle, 2003 to let's say 7, Hindustan Unilever was trading on a P of 18, right, or 17. It's on a P of 45 right now. So what I'm saying is that as the market starts to move higher, it's going to be a new leadership, and it's not going to be your defensive sector, because you're not going to get the earnings growth that you're going to see in the underlying, outside of that sector. Same with IT. I don't want to pay 45 times in consumer stocks to 15 to 16 times for single-digit growth. I just don't want to pay that much. Whereas I can find companies outside of that in the supply side or some manufacturing where the earnings are going to more than double or treble over the next 2 to 3 years. That's where I'm going to get the value. So I'm not saying that Hindustan Lever will fall, or ITC the share price will go down. The earnings will continue to improve, but the P's will just contract.
All right. So when we talk about infrastructure, and we talked about supply to infrastructure, I also want to very quickly bring in a question on real estate. And we know that this government was extremely bullish when it came in saying that they're going to build a house for every Indian. Most analysts will now turn around and say, I don't think that's going to happen because no work has been done in that area. Smart cities, no work got done in that area. If we're still talking about infrastructure, the target of, kilometers of road per day has not been met at all over the last 1 year. But do you believe that there's some merit still in companies that supply to real estate or supply to construction at this point?
Haven't been playing that side of it. I don't like real estate at all. So, but you know, if you're talking about the paint companies, I mean, again, their valuations are so high. I'm not going to get that growth, so I don't want to be in those kind of sectors. So when it's like who supplies India, you've got to look at what parts of the economy are growing, right? So when I talk about infrastructure, it's certainly not real estate.
Okay, it's not real estate.
It's not real estate.
So then what about cement and steel and all of the other things that I need in order to construct anything?
Yeah, so I mean, don't get me wrong, there is going to be construction going, but I'm not trying to play the real estate sector.
Okay.
For these companies.
I'm also going to put you on the spot a little bit and ask you, as someone who tracks the market and the economy so closely, to sort of grade the government over the last 1 year on a scale of 1 to 5. Are you impressed?
Is 1 high or 5 high?
It's 5. 5's high. On a scale of 1 to 5, 5 being the highest. Are you impressed?
5 being the highest. I think I'd go in between.
So 2.5?
Yeah. You know, there's disappointment. To be honest, I think with this mandate, this should be India's moment. You know, I spoke to you before about foreign companies saying, you know, we want to come to India. We see India as the next engine of growth away from China, but we just can't get our doors open or the welcome mat so nicely laid out that companies are rushing in. You know, we have that mat and say, well, okay, well, let's change the mat and put tax. So I think we just have to really ease the way we want companies to see India.
All right. I'm required to ask you for a disclaimer before we wrap up the show about the stocks we talked about.
I don't think I own any of those.
All right. Thank you. Andrew, thank you for coming in. It's been such a lovely pleasure. I hope to have you back on a regular basis. Remember, if you have questions for Andrew, write to us. Our email ID is at the bottom of your screen. You can reach me on Twitter as well. Thank you so much for watching.